This is Ed Jorgensen. Welcome to our January 2019 Outlook. And let me tell you, politics, culture, and the markets never fail to be interesting, right? Let's take a look. So we all know the US stock market, and indeed stock markets around the world, had a mini crash in December, really the second one of this year. The first was in January. A sell-off that was normal until the second week of December, when in a few moments stock prices just fell out of bed. And they've recovered now in early January, moving back towards the point where the computer-generated mini crash began. Now, the mini crash followed comments by central bank chairman Powell that he was going to continue to tighten money. We all know that tight money, higher interest rates, more difficult bank loans, is tough on business, and it's tough on the stock market. We never quite know what level of interest rates will generate a reaction. And I guess we could say that Chairman Powell kept pushing until he found out the level that would generate a reaction, and he sure did. So as you know, he's backed off in the last week or two, saying, oops, maybe I won't raise interest rates. I think he and the other powers that be were very taken aback by the insta crash that he was responsible for. You know, I kind of look at this a bit like World War II, and there are Marines moving inland on an island, and they never quite know when they'll find the enemy, and there's the enemy popping up out of the underbrush. In a way, the sudden crash of the stock market was a bit like the enemy popping up as Chairman Powell advanced, raising his interest rates. We never knew where the enemy was, and Chairman Powell didn't know where the reaction was. We found out in those terrible engagements on the islands of the Pacific in World War II, and Mr. Powell found out in December. So what's happened? If you look at it, the mini crash essentially moved the market back to the first plateau that was in mid 2017 after the Trump election. A reasonable point to be, really, although business has gotten better since. So we've now moved back to the green line you see there, which is the bottom point of trading in the stock market really since late 2017. We got used to the high prices, and now we're back to the lower end of the range that the market has been in for over a year. What does the business world say about the stock market? Good old Dr. Copper, one of my favorite indicators of the economy, shows a sluggish world economy, but not a depression. If construction were on hold the world around, you would see copper prices falling. Copper is very sensitive to construction. You see copper rising there in 2004, 2007. During the great boom of construction, both in the US, but particularly in China. And then copper falling during the financial crash of 2008 to 2009, when construction ground to a halt. So now copper is at an even keel, and that's probably where the economy is. China may be in recession, Europe may be in recession. We are chugging along mildly, and that's about what copper says. Is there a risk? Sure. Look at the junk bond market. You see there on the right, yields rising. That means that borrowers who are over-leveraged with too much debt, they're facing some problems, and you would expect that as interest rates rise. They took out too much debt. Now they have to pay the piper. Meanwhile, their business markets may be slowing or flat. That's not a good combination, and the junk bond market is showing that. Internationally, the economy and the stock markets have been much, much weaker than the US, and that continues. You look at international stocks, they're lower than they were 5 years ago, really devastating. Even China, the so-called growth engine, is barely higher than it was 5 years ago and has been falling noticeably since late 2017. What's going on? It's interest rates. It's the cost of money. The Federal Reserve, since the end of the Obama administration, has been raising the cost of money. And as we said, at some point it bites, and it just bit. The one thing that's helped, I'm going to talk about this a bit more later, is that oil prices are down. They've fallen drastically since early October. And that's a bit like an international tax cut for all oil-consuming countries and for the economies of the Western world. I would have said it's very hard to have a severe recession with oil prices falling really back to low levels for the past 5 years. That leaves me somewhat confident that whatever the reaction is to higher interest rates, it won't be a severe recession this year, and I don't think next. Okay, the economy is getting by, but there's a problem, and we all know what the problem is. It's our crazy battle royale in the world of politics. Boy, don't we all... Are you old enough to remember what happened to the stock market when Richard Nixon got caught at Watergate and went through that investigation leading to his resignation? Well, what happened is that the stock market collapsed. A battle royale that attempts to depose the President of the United States, and it doesn't matter what you think of him, the battle is going to shake the country, the culture, and the stock market. Also, international politics are affecting this, and I just had to show you this. Remember we talked about oil falling since October? It didn't just fall. The day that Saudi dissident journalist Khashoggi was discovered murdered, immediately the price of oil was dropped almost 40%. Now, do you think that's a coincidence? I don't. I think it's a deal. And the deal is you ignore the Khashoggi murder and we'll lower the price of oil. So there's Khashoggi, he's dead now. And there's Prince bin Salman, who they say is responsible, the current power that be in Saudi Arabia. What political events will affect markets in 2019? Here are two of them. There may be others. I just mentioned that we all focus on interest rates and market momentum. There's a lot at stake in international financial markets. Okay, so what do I think? What are we going to do? I look at the mini crash of December not as the end of the world, but as a warning. It's a warning there's too much debt. That's been true for years. But as we raise interest rates, the debt becomes a problem. The debt overseas is even more acute than here in the US. Now, in the short term, by having a mini crash, some of the margins and hedging speculative debt in the US stock market has probably been liquidated, allowing the market to, in a sense, recover. You never know how far that recovery goes, and we'll have to see the stats as they're released in the next few weeks of how much speculation was taken out of the market. Depending how much was taken out, we may have room to have the U.S. investment markets advance. But as I said, please remember the stock market in 73, 74 during the Nixon political crisis after Watergate. At the end of the day, the market did not survive the crisis. It fell 40%. So my take, I think we need to continue building our income stocks. We need to continue having quality in the portfolio. And I've actually used some of the cash reserves I built up earlier in the year. And I think we're going to get something of a recovery, and it's on balance to our benefit to bring the cash reserves down to 10% or so from 15, 20%. And then we'll reassess in at the end of the first quarter. We continually reassess, but we'll look to see if we should, if there is a rally, should we use it to lighten up and build cash back up? We'll see. So there we are. It's mid-January as I speak, and as I said, last year was interesting. This year will be even more interesting.